Fuller with Western Michigan University. I'll be graduating with a finance degree this spring in 2013. In the research challenge, the most important lesson I learned was being able to complete your drafts well ahead of time for the deadline for the final presentation, because there's a lot of fine-tuning that goes into every portion of that presentation. The biggest challenge in the competition was taking a company like Perrigo, which has different segments, and each segment reacts differently to the market, and really piecing those different segments together to come up with a final valuation of Perrigo stock. I think this challenge displays what a professional equity analyst would experience in the real world, just because there's a lot of different aspects that go into the valuation of equity. You're looking at the economy as a whole, the industry, how those two parts work with each other, as well as how that company fits in and how they'll react to different changes in the economy, the industry, and their own intercompany changes going forward. I think in my future career goals, this challenge will greatly help me out. It's going to be something that I'm going to be able to point to on my resume, showing that I have experience doing a complicated and extensive valuation of a company. Hello, I am Jeff Fuller.
I'm Kyle Bick.
I'm Steve McCooch.
We're here representing Western Michigan University in the CFA Research Challenge. Today we'll provide a generic industry overview, discuss Perrigo and its 4 key business segments, investment risks, as well as our valuation of Perrigo stock and whether or not to invest.
The generic market is forecasted to have a revenue exceeding $127 billion in 2013. And today, generic pharmaceuticals account for 40% of sales worldwide and 70% of prescription sales in the United States. Generics are growing 7.8% faster in the world pharmaceutical market, and growth is expected to continue to rise as healthcare costs do.
Perrigo was established in 1887 and is now the world's largest manufacturer of over-the-counter pharmaceutical products for the store brand market. In 2010, Perrigo acquired PBM Holdings, a manufacturer of infant formula, making them the world's largest supplier of store brand infant formula. Perrigo also acquired Sargent in 2012, a manufacturer of pet care products. We expect Perrigo to expand pet care to store brands utilizing their expertise in store brand marketing, established supply chains, and their generic pricing model to drive future growth. Much of Perrigo's rapid and continued growth is a result of their key business model. As you can see here, there is substantial savings over brand name products for Perrigo's primary customers, large retailers. Retailers sell a store brand product comparable to the name brand product for less. At the same time, the retailer will earn a higher operating margin on the sale. There is also savings for the final consumer up to 26% over name branded pharmaceuticals. With healthcare costs constantly rising, consumers are transitioning their purchases to store brand and generic pharmaceuticals, fueling Perrigo's future sales growth. The majority of Perrigo's business stems from their over-the-counter drugs. As prescription drugs transition to over-the-counter, Perrigo is able to expand their existing sales by adding products to an already established base.
Perrigo has 4 primary business segments: consumer healthcare products, which consist of generic over-the-counter pharmaceuticals; nutritionals, consist of generic infant and parent formulas; prescription pharmaceuticals, which consist of generic prescription topical pharmaceuticals; and active pharmaceutical ingredients, or API, which are the active drugs in pharmaceuticals. And as you can see, consumer healthcare accounts for 57% of Perrigo's revenue, while prescription pharmaceutical accounts for 20%, nutritionals accounts for 16%, and API for 5%. Consumer healthcare accounts for 49% of operating income. Prescription pharmaceutical accounts for 37% of operating income, which is a much higher share than its total revenue. Perrigo's consolidated revenue is shown here broken down by segments. As you can see, in 2009, there's substantial growth in consumer healthcare products as consumers chose lower cost store brands. When there was an economic downturn, there's an increase in growth of sales in generic pharmaceuticals. There was also rapid growth in 2011 and 2012 as the prescription pharmaceutical segment was bolstered by the addition of Colbrec.
Consumer healthcare is Perrigo's primary resource for operating revenue and operating income, accounting for 57% and 49% respectively. Revenue in consumer healthcare has shown the highest levels of growth during the years of 2008 and 2009 when there's an economic recession. Growth those years averaged 25%. In the years 2011 and 2012, that growth slowed to 7.5%. We have forecasted growth in 2013 to be 15%, which is below Perigo's forecast of 16 to 20%. Growth is forecast to slow to 7% by the year 2017. Operating margin in consumer healthcare is forecasted to improve in 2013 due to a decrease in the cost of sales. Our forecast for operating margin is 17%, while Perigo has their forecast at 17 to 21%. Operating income is forecasted to grow at 12% a year behind the growth of gross revenue and a slight increase in operating margin.
Nutritionals account for 16% of revenue and 5% of operating income. Revenue in nutritionals took a large jump in 2011 with the acquisition of PBM Holdings. Revenue is forecast to grow through 2017 as Perigo continues to improve store brand penetration of generic infant formulas in the United States and China. Nutritionals operating margin is expected to improve as Perigo improves their positioning in the newly acquired segment. Nutritionals operating income is forecast to grow with sales. Our forecast of operating margin of 11% is lower than Perigo's forecast of 12 to 17%, which still results in significant increases in operating income.
Prescription pharmaceuticals account for 20% of Perigo's revenue and 37% of operating income. Prescription pharmaceuticals revenue has shown great growth since the initial 18.5% acquisition of Cobra. Now that Perigo has announced it will require the remaining share, revenue is forecast to have a growth of 17% in 2013, which is in the middle of Perigo's forecast of 15 to 19% growth. Along with the growth in revenue, operating margins have improved as Perigo's expertise in the generic markets has been applied to the newly acquired Cobra. With the increase in sales and operating margin, operating income in the prescription pharmaceutical segment is forecasted to grow to $443 million by 2017.
Active pharmaceutical ingredients account for 5% of Perigo's revenue and 9% of operating income. API revenue is forecasted to grow with direct relation to the increase in sales in consumer healthcare products as well as RX pharmaceuticals. API's operating margins have shown great improvement after a 2009 restructuring, and our forecast for 2013 is 20% operating margin, which is at the low end of Perigo's 27 to 32% forecast. Operating income is expected to grow from 2013 numbers due to an increase in sales of Perigo's other key business segments.
One risk to Perigo is increased competition. For example, Johnson & Johnson will be re-entering the generic drug market.
Another risk to Perigo is the customer scale. Perigo allows customers to consolidate purchases, so losing any single customer may adversely affect sales. For example, Walmart accounts for 20% of revenue, however the risk declines as Perigo expands business segments and international growth.
Perigo also experiences a pricing power risk. Perigo is selling their products to large retail chains. Companies such as Target have a pricing power over Perigo of what they're willing to pay for such products. And as new generic pharmaceutical manufacturers enter the market, adding more options for these retailers, it limits the future growth that Perigo may experience. Regulation is also an investment risk with Perigo. The pharmaceutical industry is highly regulated, so changes in regulation may adversely affect sales.
To recap, we have forecasted Perigo's revenue to increase as a result of Perigo's pricing model. It allows retailers to generate higher margins on products while also allowing the customer to save on healthcare. International growth will be driven by increased sales of infant formula in China. Sales in generics are also expected to grow with the expansion of large retail stores overseas.
In addition, new product revenue may be driven by the more than 60 products making the switch from RX to OTC in 2013. Prescription pharmaceuticals have the highest operating margin of Perigo's 4 primary business segments, and the segment is expected to grow with the addition of Cobra.
We have our 5-year projections of revenue growth and operating income. Operating income growth is growing at a rate slightly better than the revenue growth, and this is due to the reduction of cost of sales, which is in part from the streamlining of processes, as well as the integration of their vertically integrated products, the API segment. Free cash flow growth here is forecast to be 8.46% a year. This is from sustainable organic growth within the company. With each individual segment's contribution to the company as a whole, we estimated the invested capital value of Perigo at $12.6 billion. This brings us to a fair share value of $125.08 using our conservative estimates of future growth. At the time of the conclusion of our analysis, Perrigo was currently trading at $104 per share of the stock, so we recommendation of a buy of Perrigo stock. I'm Jeff Oler.
I'm Kyle Bick.
I'm Stephen Cooch.
We're here representing Western Michigan University in the CFA Challenge. Any questions?
You mentioned one of the risks was on the consumer health side, the customer scale, particularly Walmart at 25. How does it look behind Walmart? Is it,
Some of the larger customers, such as CVS, are still above 10%.
And in the past years, Walmart has accounted for 23%, 22, 21. Their actual share is shrinking as Perrigo's expanding their business segments. Like with Sargent, they just recently acquired another pet care pharmaceutical manufacturer, so that risk is going on the trend down.
Who would be their competitor in the consumer health care? Who else is supplying Walmart with and Target with product?
As far as genetics go, Perrigo's 85% is their market. They're supplying 85%. That other 15% is Watson Pharmaceuticals.
Dr. Reddy's Labs.
And Johnson & Johnson's newly coming back into the market. They haven't yet, so it has just been announced.
As well as Teva Pharmaceuticals.
And on the pharmaceutical side, as opposed to the consumer healthcare side, if you can make that distinction, who are their big competitors on the generic pharmaceutical side?
On a global scale or on a domestic?
On a global scale, yeah.
On the prescription side, their only competitors are international, as Perrigo's the only manufacturer in the United States of the topical RX in that segment.
What would be a barrier for one of the other big players in that industry to come in and compete in that business?
Topicals really highly regulated, and that's why Perrigo's business model, they want to be the first in, last in strategy, and also the hardest to penetrate markets, which is topicals. For some reason, an ointment is much more harder to manufacture than the actual pills, something you ingest. So that's the reason Perrigo acquired them, is because it was some market really hard to enter, as well as to the amount of capital it would take to get that company up and running to meet regulation standards.
speaking of acquisitions, this company has grown quite a bit via acquisitions.
Mm-hmm.
What's your sense of how they've been able to deliver on what they thought they could do with these acquisitions?
Perrigo stated that they want to earn 2% to 3% above their weighted average cost of capital on any investment, and so far they have a good track record of achieving that just through the growth in sales from every acquisition they've had in recent mergers.
What do you think about the formula, the infant formula company? That seems to have been a little more, taken them a little more time to get that, to get that where they want it, or do you think that's on track?
It's on track. There's some, Perrigo's expressed their own concern in it, was when you have infant formula, parents don't want to go for the cheaper brand, even though it's comparable. It's their child, so they want to spend on whatever's best. But as cost of healthcare continues to rise, as other costs, I would see that transitioning to
In addition to what Jeff mentioned, they spent a few months retooling to produce their packaging that's very similar to the market leader. And when their product, I forget, do we have the numbers in our appendix?
Yes.
To the products?
They just recently reintroduced the packaging for the nutritional segment. The infant formula went from almost a coffee can down to a plastic tub, and it's to meet the packaging standards of the other companies. They have a new and innovative scoop which helps at the end user measure out their formula. So they're expecting a growth in sales from that, as well as they just have launched 3 new nutritional products in China, 3 new formulations of infant formula, which will help sales in China grow.
On balance, many of the estimates that you have are lower than those of the management. Why is that?
We wanted to be conservative in our estimates, using historical averages as well as what Perrigo forecasted. They do have their forecasted, which is higher than ours. They might be a little optimistic. We might be a little too conservative, but even using our conservative estimates, we still have them very undervalued.
Has management hit their targets in the past?
In the last 5 years, they have in growth. They've sustained, as you mentioned, 2 to 3% over weighted average cost of capital and acquisitions.
No, I mean in terms of when they make estimates on revenue growth, the earnings per share, things of that, or earnings generally.
Past statements, historically they have, I think it's their first quarter is usually their low quarter, but beyond that, the other quarters, their earnings have exceeded their forecasts.
And they have increased operating margins, which is one of their main goals in the last at least 3 years.
In your appendix, and you're detailing your evaluation and your beta calculation, your assumption for expected return, cost of equity. Can you talk a little bit about those assumptions and how you came up with those numbers?
The beta, we took the S&P 500 growth and then compared it to the growth in Parago's share, and that's how we got the beta at 6.478, which is pretty comparable like when we were looking at other valuations on the internet, that our calculation is right. Expected return, calculated by the average of both the S&P 500 and for 2011, 2012, and the compound growth rate for those. We averaged both the average return and the compound to get the 9.1% in the middle. I think one was 8 and one was 10, 11. Cost of equity, we did a couple different costs of equity calculations. They all came out with a little slightly different numbers. The earnings price ratio was really low, so we wanted to still put that in where it's the earnings per share for 2012 divided by the share price at the time, 104. The dividend calculation, the expected dividend in the future is 34 cents in 2013 by the current share price. And then you add the annual compound growth rate of the dividend, which was 10.475%. In the last one, we had two different capital asset pricing models. One was the product of the 30-year risk-free rate, Parago's beta, and the equity risk premium. That was the earnings per share divided by the share price. And the second capital asset pricing model was the expected return minus the risk-free rate multiplied by the Parago's beta, and then add the risk-free rate. Risk-free rate was the 30-year T-bill, which is a long investment, but interest rates I would assume would climb up a little bit, so making as the industry moves back.
More normal. I think in my college days we used T-bills.
Yeah, I think the 90-day T-bill, right?
Right. I was looking at the 90-day
Yeah,
T-bill,
yeah.
but it was
it doesn't
a tenth
work.
of a
Did you have any
percent.
challenges when you were evaluating and looking at Parago? It's changed and grown a lot. So when you go back looking at historical things, maybe talk about that and how you made adjustments to your assumptions, because it's a bigger and different company and growing in different areas.
Consumer healthcare that had the largest data sample because that's what they've been manufacturing for the longest, like your generic NyQuil's, products of that, over-the-counter products. The RX pharmaceuticals, going back to our evaluations of historic growth, you see like nutritionals and RX pharmaceuticals had high growth. That's because it's such a small sample size. They've only been in those markets for a couple of years now. So we were just taking Parago's estimated growth,
Right.
looking at what products, what they expect to get from those products to get our future growth estimates.
You know, if you grow by acquisition, you bring in new management teams, you bring in different cultures within a company. Can you touch on Parago's ability to attract and retain good talent?
For the past, I think since 2006, they've had the same top 3 executives within Parago's company, and they've been running the company very well in our opinion. So their ability to retain those employees, I believe, would continue in the future as long as those chief executive officers are there, chief financial officers.
They seem to in-house as well have a pretty lengthy interview process, or at least a fit process, because their executives that they brought on board since 2006 have performed extremely well. And they seem to have remained around as well. So it's
Have they been able to retain the executives of the companies that they acquire?
how did they?
Have they been able to?
They seem to have in the last 5 years. Recent structure, whether it be through compensation or
Yeah.
likewise.
How are they compensated? Is senior management compensated with equity at a high level? Is that a high percentage of their compensation, low?
I know they have both salary as well as options in the shares, but I don't have those percentages with us right now.
The one of the things they do a lot of is go from prescription to an over-the-counter formulation.
Mhm.
What's your sense of the opportunity pipeline for that?
In the future, there's one product to look at, the statins, like Lipitor, Crestor, those products. There's been FDA applications put in by other companies to try getting that product to switch from prescription to over-counter.
In their presentation, investor presentation, they had 3 drugs that were highlighted. The 2nd, the 6th, and the 7th most profitable drug in 2012 that just came off pipeline. $16 billion market that they had interest in, which if they can get the licensing or 180 days exclusivity, we will see. They expressed interest in the $16 billion market.
And that streamline is expected to continue with 2013. There's over 60 products making the switch, which Perrigo is not going to manufacture, and it's $190 million in revenue from those products.
Okay. Strong. Okay.
And there's a couple of really big ones out there on the horizon.
Thanks, guys.